But if people start losing jobs, then all bets are off. Again, I don't think there's anything really severe on the horizon, but...
Recently, in an interview, Roaul Pal talked about why he's so bullish about the crypto and blockchain sector. He also talked about his predictions amidst the current crash. He also said, "If you think that the future is in technology, namely blockchain technology, then this entire digital asset area should beat the safe haven. That's just the way things are. If you're in an exponential uptrend because you're in a network adoption model that applies to the entire space, not just Bitcoin, then it should outperform over time. That's all there is to it. It's not a value statement like, I dislike Bitcoin because X and prefer Ethereum because Y. It all comes down to network adoption models. Once you realize it, you may liberate your mind of all the tails that are in the various buckets." If you want to hear Raoul Pal's comments on the crypto market and more about his current holdings, then watch this video all the way to the finish and don't forget to press the like button and share your thoughts on her interview. Now, let's look at his interview.
You know, you can argue whether Kathy, who I had coffee with yesterday actually, whether she's got the right stocks in her portfolio or not, fine. But then the Scottish Mortgage Trust that have an excellent track record at doing this as well, the long end of growth, they're down. Let's have a look where Scottish Mortgage Trust is down this year. I mean, they're down 32%. So you can see there's a lot of damage in that. Amazon is a really interesting story. People aren't paying attention. Amazon, the world's largest retailer, is saying they're overstaffed. They said it in their statement. They're overstaffed, and the year-on-year comparisons versus a strong year last year because of COVID is going to make them look bad. But the overstaffing element makes me think that there's layoffs to come. And I think there's broader layoffs to come because of this fall in consumption. Because if you think about it, last year, particularly in these kind of stocks, there was an enormous amount of staffing to deal with the excess demand. Well, that excess demand is now gone. And therefore, you're likely to see they're going to have to trim some of the staff. So, you know, this is not a good setup. But in terms of equity markets, the average recession, and this doesn't feel like it's a financial crisis in the brewing. It feels like, I've been talking about for a while, that the business cycle is going to get shorter and slightly more violent as opposed to the long moderation period we've gone through since '87 or so. So if that's the case, then it could be a shorter, sharper clearing event. And the average kind of recession in that sees the equity market down between 20 and 30%. So I think we're getting closer to the bottom than the top, but who knows, you know, only time will tell. Maybe things develop that get uglier. The economy seems to have slowed really fast. So, you know, because what's happened is everybody built inventories because of supply backlogs, right? The right thing to do. Supply backlogs clear, demand falls because of high commodity prices and inflation. Everyone's stuck with a whole bunch of inventories that need to be liquidated.
Yeah.
That's not good. And we're seeing the supply backlogs clear because, you know, the Port of Long Beach in the US, much clearer now. We're seeing the same with freight traffic has gone negative year on year, suggesting that the economy may slow significantly forward. So those kind of indicators, restaurants been weak. The consumer has offset some of this by credit. So we've seen them drawing down their savings. So the savings ratio has been collapsing. But consumer credit has held up. And that's what traditionally happens in the US. They balance off savings and credit. But if people start losing jobs, then all bets are off. Again, I don't think there's anything really severe on the horizon. But let's keep an eye on it. Europe, different story here. You know, Europe's between a rock and a hard place because of the reliance on Russian commodities, particularly on gas. And Europe's in the transition to ESG. That transition is going to take the best part of a decade before it really starts taking marginal demand away from fossil fuels. And they're steadfastly wanting to adhere to that, and I think it's the right thing to do, but they're going to have to take pain in the middle, and the pain is the economy. And what's happening is the outlet valve for that right now is the euro, which has been going down fast. You know, we've seen the outlet valve in Japan being the yen going down fast, and we're starting to see the outlet valve in China being the RMB going down. Now, that's actually good. The rising dollar is bad in the short term because it creates funding problems. and it can slow growth significantly. But if these economies see cheaper currencies over time, it's going to create a larger deflationary wave because they're all exporting nations. So there's kind of the bad of the strong dollar and the good of the strong dollar all at play, but that's a phased thing. First, the dollar up fast is a bad thing. Then a weak set of global currencies helps them get traction and recover.
Raoul, we've talked about a lot of data points here, but I want to point this out because it's a pretty striking coincidence. Here we are on a Friday afternoon, markets, NASDAQ specifically losing over 4%. And on Monday, we start this global recession watch series. What was it that clued you in to know? I mean, these series take weeks and months to plan. How did you see this narrative starting to build?
I could see it in the economic data. I could see it in the positioning in the markets. I could see it in how things were trading, things like consumer discretionary versus consumer cyclicals, that kind of stuff. I could see it written large that we're going to get a slowdown. And so that's why I thought, okay, this is starting to get concerning. Now, I've been looking at this narrative developing for 9 months. Economies take a long time. There's only 9 data points, monthly economic data. But I've seen it writ large for a long time. I've been writing about it in Macro Insiders for a long time. Now, I could have taken the commodity trade, but my time horizon and my secular framework means that I tend to err on the side of the disinflationary. So I would rather take the setup and wait for this bigger setup, which I think is coming. So, yeah, I mean, it so happened that the timing got spot on. But, I use a whole group of things from secular trends, business cycle, to technical analysis and flow of funds. What you do is you might stop consumer behavior. You might stop marginal dollars flowing into developing new projects.
Yeah.
But the technological adoption of whether it's robotics or AI or space or crypto or any of these genetics, that's not going away.
Yeah.
So even if they trade sideways, they become cheap over time because the network adoption keeps growing. Now, sure, recessions can slow these things somewhat. But yes, so
the stock can get whacked in the interim, of course, as we see.
Yes, and you need to use logarithmic charts and understand that these are volatile things. So you use logarithmic charts, and I like the regression channels that I use, and you look for things like monthly log charts where they get 2 standard deviations oversold, things start to become interesting. Now, for anybody interested, I kick off the entire global recession campaign with an hour-and-a-half piece where I basically mind dump everything, and there's about 50 charts. The production team hate me because I gave them so many charts, but I wanted to get across in my head everything that's here because you can double click on any point I'm making, and I've been writing about all of these things, whether it's for decades, years, months, or weeks. That there's a big depth to it all, and I couldn't even cover it. I could have spoken for 3 hours, but I got bored of looking at myself on screen talking to myself because I did it all in one piece to camera, as in my classic fashion.
Yeah. By the way, I cheated a little bit, sneaked into our media server, and got a sneak peek of it. The charts are fantastic.
Oh, good. Yeah, but there's a lot there which explains a lot of why I've got this thing. These are not just based on, well, I kind of feel that. So, as I said, the next shoe to drop for me is let's see what oil does. And then I'm starting to get very close to my DMARC indicator counts on bonds. So next week would be the weekly 9s and 13s all in place. But usually at the top of the chart of truth, the big 40-year trend channel where we've just broken out, I think it fails. And normally we get the monthly DMARC. That wouldn't be till June. So I'm thinking much like 2018, we kind of get this peak inflation fears. It starts dropping off. It kind of corrects a bit. And then maybe later in the year, the back end of the year, yields really start to fall as kind of people realize that both inflation and growth are disappearing.